For more on the markets right now, we want to bring in Jeremy Siegel. He is professor emeritus of finance at the University of Pennsylvania's Wharton School of Business. He's also chief economist at Wisdom Tree. And Jeremy, the thing that I've been watching pretty closely lately is just how Treasury yields have moved up. They're a little lower today, but they have moved up substantially in recent weeks as we got these hotter than anticipated inflation numbers. And yet the stock market keeps hitting new highs. If the Fed comes out and is hawkish today, can that continue?
I think the Fed will be hawkish today. In fact, I'm expecting the number of cuts to decline from the 3 that we saw in December to 2. And by the way, I wouldn't be surprised if more people, more FOMC members predicted less than 2 than more than 2. I think the economy has remained very, very strong, stronger than the Fed expected, very definitely. So they're in no rush to actually cut the rates. So I think I'm not sure the market is quite prepared for that. I've been hearing that most observers still think that they're going to do 3 cuts by year end, but I don't think so. I think right now they're predicting 2. Of course, circumstances will evolve as they evolve. They can't predict the future, but at least at this particular point, I think there's going to be a shift to hawkishness today at the meeting.
Jeremy, how much of the gains we're seeing in the market do you think is predicated on the Fed being more aggressive with rate cuts? How much is just based on this great economy itself? Because I guess the good news in all of this is if the Fed's not cutting rates, it's because the economy's looking pretty good.
Absolutely. I've said that before. It's more important that the economy stays strong and then earnings stay up than whether the Fed cuts in June or July or September or October. As I said, probably some of the worst news, if you heard they're going to cut 100 basis points in the next 3 or 4 months, I would say, oh, my God, what happened? This is not good. So it is absolutely the strong economy that's driving the earnings. And that's why they seem to be ignoring whether we're really going to have 3 or 4 cuts, because it is more important for economic strength for the stock market than when they're going to cut. Now, what is important is that the Fed doesn't make a mistake and wait too long. But there's no sign that if they see the economy really slowing, that they won't then cut the rates. I think that was the signal that was given last December that encouraged the market still on the table. If we see weakness, we will cut rates. If we don't see weakness, then at this particular point, we're happy with the rates as they are. Their measure of inflation is stickier. My measure is it's lower because of the shelter distortion. But nonetheless, the economic activity is the main mover of how they change the Fed funds rate.
Okay. If you're right, they're more hawkish, they don't cut rates, we do continue to see this strong economy. What's your guess for where stocks wind up later this year?
Well, I think that, again, they made a hiccup at 2 o'clock. When we get that 2 o'clock dot plot, I think there might be a hiccup. I think during the news conference, Powell actually repeats a lot of what the projections are. He's not going to back off, although he's, I think that today might not be the best day for risk assets. But I think that once people realize, hey, he's doing. Yeah, exactly. Once he says, well, that's because the economy is so strong, I don't think this bull market is over. I think the momentum is still there, still on the upside. I don't think we've seen the highs of the year.
Okay, one quick question for you. Do you think the leadership remains with the technology stocks and others, or do you think the baton gets handed off and manufacturing and other sectors kind of pick up and run?
I think they will eventually, but right now I still think the technology stocks have the momentum.